in listen-only mode.
Well, hello everyone. Tom Dixon here, your host of the Financial Experts Network, broadcasting live from location unknown. I won't say I'm in the witness protection program, but unfortunately my webcam is not working, so you have audio only. But delighted everyone could join us today for what I think is a fascinating discussion, what will be a fascinating discussion and introduction of an altogether new home equity product, which has been pioneered by, you'll see one of the two principals on screen, Craig Korn, along with Dan Anderson, who are the co-founders of Cornerstone Financing. And Craig will tell you a little more about that and some of his background. And then also happy to have, for the first time ever, David and Don from InsMark, who have a really neat, I'll call it planning software that they're going to really introduce as part of this discussion today. So I wanted to make this introduction in part because I've known Craig for, hard to believe, I think 17 years. We go back a long, long way. And I've worked with Craig at two different firms, one being MetLife and the other being Reverse Mortgage Funding, otherwise known as RMF. Craig has a proven history of being a leader, an innovator, a disruptor in the home equity market. His time prior to Cornerstone was spent largely in the reverse mortgage space, where I too was in that industry. Many of you may not be aware of that, for 11 years plus as an educator on the product, an evangelist trying to introduce just the idea of considering something like a reverse mortgage as you really try to help your clients secure their retirement. Well, guess what? Craig's at it again, and he's created an altogether new solution. And so what I would ask of all of you listening closely here is, after this session, after the presentation is done, before we go to Q&A, Missy will take over the Q&A, but she will present two polling questions, one of which is, if you'd like to learn more about Craig and Dan's new product, the CHEIFS, I'll call it the CHEIFS product, you can opt in. I would absolutely highly recommend you do that. And in doing so, get an illustration, see how the numbers work, what it would mean for your clients. That's what I found to be the light bulb moment for the thousands of financial planners that I worked with previously when introducing reverse mortgages. And best case is do that in the context of using the Wealthy and Wise system from InsMark, because I've not seen a better illustration, a better handling of this strategy in any other financial planning software like Don and David had put together in Wealthy and Wise. So you'll have the option to opt in to learn about both. I hope you take full advantage of that. Now, so I'm here to say, I think it's a great idea. I hope you take advantage of the opportunity to learn more post this session. And I'm here to say, I've known Craig a long time. If Craig's involved, I think there's a lot of credibility with this solution. So with that, let me pivot to today's session is worth one continuing education credit for all of you who are subscribers to the Financial Experts platform. Plus, if you came in via the links from either Cornerstone or from InsMark, again, you're eligible for a continuing education credit. Now, that credit applies for those of you who have the CFP designation, which in turn means that it's eligible for the American College designations, CLU, CHFC, RICP, alphabet soup, right? Then, of course, if you're a subscriber, you can also earn a CPE credit. And I believe, I'm not sure if it's eligible for enrolled agent, but I'll have Missy edit or comment on that later. Now, to earn that credit, I ask that you stay on until at least 1:55 Eastern time. We do track your time in session automatically, the system does, so you want to make sure you satisfy that requirement. And then last but not least, if you did not see the email that we sent out multiple times with a copy of the slides, I'd encourage you to go to the handouts line or tab in the GoToWebinar interface, and you'll find a copy of the slides that Craig and team are going to walk you through. So again, and by the way, you can start posting questions at any point in time, and we will again get to questions at roughly, I'm going to say 1:50, 1:55 Eastern. And I already saw a question in about the CE credit. So Barbara, yes. And for everybody listening again, if you're a subscriber to our platform, a regular subscriber, of course, it's eligible for that purpose. But in addition to that, if you came in, you're a friend of InsMark or CHEIFS, and you use their link to register, we will also provide that CE credit as well. So with that, everyone, thanks for your patience. Craig, team, so great to have you. Thanks so much for doing this, and it's all yours.
Tom, that was a really great introduction, so thank you very much. I appreciate it, and it's wonderful to be working with you again after all these years. We want to thank everyone for attending this webinar today. We're excited to present this innovative concept of utilizing home equity for retirement and financial planning. As Tom said, my name is Craig Korn. Along with my partner, Dan Anderson, we're the founders of Cornerstone Financing. This is the company that has delivered to the financial advisor community our CHEIFS funding product and program, where for the first time, advisors can efficiently utilize their clients' dormant home equity, which we all know is oftentimes their largest asset class on their personal balance sheet, as an alternative way to fund critically important retirement-oriented investment and insurance products and strategies, as opposed to using cash on hand or liquidating assets under management. In addition, as Tom mentioned, we've partnered with InsMark, the leading provider of insurance and investment planning software, through their Wealthy and Wise platform to integrate our CHEIFS product and program into their planning tools in order to provide the thousands of advisors who use their platform today in a compliant manner the ability to compare a client's status quo scenario against the financial planning strategy involving CHEIFS. We're delighted to have Don Pren and Dave Grant from InsMark here today to discuss actionable strategies using home equity via home equity instruments such as CHEIFS through the lens of their Wealthy and Wise technology. So let's kick off this session talking about home equity instruments, and better known as HEI, and how you can use HEI products to better serve your customers. So I'll start with this. HEI are home equity funding instruments that have been used for several decades now. The easiest way to think about them, in my opinion, is they allow homeowners the ability to sell a fraction of their home in return for a lump sum of money, without the requirement to make any monthly payments while the transaction is outstanding. HEI products literally change the paradigm that an individual can only own either 100% of their home or 0% of their home, which makes them a renter. HEI products allow homeowners to sell a fraction of their home, yet still retain 100% of the utility benefits associated with home ownership. While most HEI products have a fixed maturity date, typically either 10 or 30 years, when the contract must be unwound, CHEIFS have no maturity, with repayment being triggered either by death, permanent move out, or voluntary repayment, which creates great flexibility for the borrower. It's something that we learned from the reverse mortgage space. We thought that was an important feature to incorporate into our CHEIFS HEI product. HEI products are typically allowed only on owner-occupied properties, which can include a second home, a third home, or any number of homes that your clients occupy but don't use as investment properties. In addition, HEI products can be executed on residential property that have an existing mortgage, where HEI and CHEIFS can sit in a second position behind the existing mortgage. HEI products have been structured to provide homeowner protections, such as the homeowner always retaining a financial interest in the home, typically a minimum of 20 to 50% of the value of the property, to ensure appropriate alignment between the homeowner and a company like Cornerstone Financing. Other protections include capping the costs the homeowner can potentially pay out, typically as low as 12.99% annualized cost to as high as 19.99% annualized cost. And this is to protect against the risk that home prices shoot up so dramatically that the homeowner is paying out much more than the upfront benefit received at the time of transaction. In addition, and this is important, HEI also share in losses should home prices depreciate over time. It truly is like selling a portion of your AUM with protections in place to avoid severely negative outcomes to the homeowner. Cornerstone's chief product is an HEI product designed for the mass affluent and higher net worth demographic served by financial advisors such as yourselves. We created CHEIFS to address perhaps the most challenging part of providing financial advice, which is how to fund the products and strategies so important to your clients recommended by you all. Historically, the options are pretty limited to either cash on hand or AUM liquidation, which have their own consequences, such as reducing your client's liquidity or having to address tax implications of what is oftentimes a highly appreciated stock portfolio, putting aside the fact that AUM liquidation eliminates future opportunity gains. And as you all know, where you invest your client's money matters. The stock market has outperformed the housing market by nearly 8% per year over the past 80 years. The market opportunity is enormous, considering the significant amount of home equity tied up in the housing market. And HEI products have become much more popular in the 5 years post-COVID, where we've seen a significant increase in home equity. At Cornerstone, we saw this as an opportunity to present to financial advisors a $35 trillion dormant asset class that can be used as an alternative way to fund investment and insurance products that would normally be funded with cash on hand and AUM liquidation, such as the $450 billion in new life insurance, annuity, and long-term care products and premiums that were originated in 2024. So let's discuss Cornerstone's home equity investment funding solutions, better known as CHEIFS, and how they work. Very simply, for every dollar we invest in your client's home, we initially own a percentage of the home equal to the amount invested divided by the home value. Our ownership percentage will then grow over time to provide Cornerstone an opportunity to make a commercial return on its investment, but in no instance will our investment return be greater than a 12.99% annualized return, with the expectations that our returns will be closer to 5 to 10% based on long-term home price appreciation. You can see this return profile on the yellow line in this graph. But let's go through a real example. Assume we invest $100,000 in your client's $1 million home. At the time of closing, we own 10% of your client's home. That ownership percentage would then grow over time, ultimately reaching, in this example, a maximum ownership percentage of 22.5% of your client's home, evidenced by the green line in this graph. As you can see, the increase in ownership percentage from 10% to 22.5% typically takes about 8 years. During that time period, assuming home prices were to appreciate 3% per year, which is the assumption in this example, if the homeowner were to pass away or permanently move out or otherwise pay the transaction off, it is more likely than not that the cost to the homeowner would be roughly 12.99% annualized. However, and this is important, once we reach our maximum ownership percentage, the costs of entering into a CHEIFS contract start to come down dramatically, ultimately approaching long-term home price appreciation rates. As you can see here in the graph, where a homeowner having a CHEIFS transaction outstanding for 10 plus years, the costs are actually very attractive relative to other home financing products. This dynamic is important to understand because CHEIFS, they're really not intended to be considered for short-term funding strategies and solutions. As a sidebar, most financing transactions tend to be expensive if paid off quickly, which you can see on the next slide. The takeaway here is that if your client enters into a CHEIFS transaction to fund important investment insurance products, the longer the better. And for much longer, there's nothing more attractive than CHEIFS from a funding perspective. This slide is intended to demonstrate how CHEIFS compare with reverse mortgages and home equity lines of credit. While home equity lines of credit can be cheaper from an annualized cost perspective, it's important to note that monthly payments are required, which come from after-tax dollars, making HELOCs actually quite expensive relative to CHEIFS. Likewise, reverse mortgages tend to be considered the financing product of last resort, given the high upfront costs. And you can see that clearly demonstrated in the graph, with reverse mortgages being much more expensive than CHEIFS and HELOCs in the first 4 or 5 years. In addition, and now I want to talk about sort of the investment, certainly the insurance opportunity associated with using CHEIFS. Given the cost profile of CHEIFS, it's easy to see from an asset allocation perspective how the cost of CHEIFS stacks up versus the potential returns associated with deploying CHEIFS proceeds into longer-term investments, such as 529 college saving plans. At a 10% investment yield, which is the light green on this graph, the break-even time horizon is roughly 12 years, assuming your investments have a 10% yield. And given the long-term performance of equity investments such as the S&P 500, it's clear that longer-term strategies using CHEIFS funding start to make a lot of sense, including strategies involving the funding of insurance constructs, which we're going to describe on the next few slides. Here's a real example of how an advisor used CHEIFS to improve their client's retirement outcome. This is a 60-year-old female in a $600,000 home with no mortgage, with modest qualified and non-qualified investments. Her goal simply is to cover her potential long-term care needs, not be a burden on her children, and if possible, leave a small legacy for her grandchildren. The solution was to sell approximately 19% of her home initially, generating nearly $114,000 in cash, and use it to purchase a $500,000 nationwide IUL with LTC benefits. The benefit of using CHEIFS versus cash was several-fold. She remains liquid and invested in the market. She has a $500,000 long-term care benefit and a $500,000 death benefit, meeting her long-term care and legacy goals. And interestingly, the internal rates of return are higher with CHEIFS versus what was disclosed on the policy when paid for in cash in every single claim year, whether it was an LTC claim or a death benefit claim. And this comes down to the simple math equation that paying for products upfront with cash tends to anchor down internal rates of return, whereas paying for products in the future and allowing the money that was not spent to purchase the insurance product to remain invested results in much higher internal rates of return. Here's another example. And what's neat about this one is that when I'm done, Don Pren at InsMark is going to walk you through a similar scenario using their Wealthy and Wise advanced technology. So here, a 45-year-old female with 3 teenage children living in a $1 million home with a small mortgage, who has a well-funded 529 college plan, but a small amount of qualified investments, is concerned about running out of money. And that's a common concern these days. Her advisor suggests that she purchase an Allianz ABC lifetime annuity. But practically speaking, she doesn't have the liquidity to afford such a product. With a CHEIFS, she sells 10% of her home initially and monetizes $100,000 to purchase this annuity. At age 71, she can trigger the annuity payments to generate over $205,000 a year of annuity income. Interestingly, if she chose to, she could use some of that annuity income at age 71 to take out a mortgage to pay off the chief's liability, which at that time is roughly $485,000, and still be left with $170,000 annually from the annuity. So using CHEIFS, she not only ensures that she has lifelong income, but also retains the ability to fund her children's education and preserves optionality for her heirs should they wish to keep the house. It's a real win-win. So let me now turn things over to Don, and then I'll jump back shortly.
Okay, so let me just kind of explain sort of foundationally. In InsMark, we've been around 40 years, and we have a number of different software products. Our flagship product is called Wealthy and Wise. And basically what Wealthy and Wise does is you go in and create your status quo case for your client. So it's their assets, liabilities, when they want to retire, their assumptions on investments and taxes, and it sort of projects out into the future from the clients, whatever their age is now, into the future, and tells you sort of what happens to their ability to produce the income they need, what happens to their net worth, what happens to their liquidity, and so on. And so this first case that you're looking at, it's Bill and Mary Simpson. They're 55 and 54, as you can see in year one. They have $1.1 million in qualified plans, 1.2 million in non-qualified. Bill's a marketing consultant, Mary's a registered nurse. They don't plan to contribute much to their pension or savings the next 10 years. They want to travel, and they've got charitable things they want to do. They do own a $1.5 million home, in this case, owned free and clear. So as you look at strategy one, we asked them, we said, okay, so what year you want to retire? And they said, well, in about 10 years. And we said, okay, how much income do you think you're going to need? And they said, well, 10 years from now, with inflation, let's say 225,000, and we'll index it, with inflation. That's why it goes up each year. And what you can see is when we tried to fund, and I'll show you the details of this in a minute with the software, but I just want to give you the concept. When we tried to fund the 225,000 of net spendable money during retirement, you can see that when we reached age 84, they kind of ran out of liquidity, and then they had 36,000 a year from Social Security. So strategy one, which is don't do anything new, just keep going the way you're going, ends in disaster at age 84. And so what we did is we took the exact same case in Wealthy and Wise, and we added one change, which was we did a CHEIFS cash transaction, generated $326,000 from their home from CHEIFS, and we then redeployed that into an Allianz ABC annuity with accumulation, and I'll show you the details in a minute. But the result was that we were able to fund the 225,000 in column 2 with the green in all years, all the way out 40 years, and we still had over on the right, we still had $875,000 of liquidity still remaining. So the whole point of Wealthy and Wise is not to push any particular product. It's to show status quo and then make a change and see if things are better or worse. For example, you could have a client that says, I want to retire it in 10 years and run the status quo, and let's say it's not a good result or they run out of money. You could run scenario 2 where they retire at age 70. It doesn't always have to be a product change. Just as a, kind of the foundation. If you go to the next slide. So what this is showing, and I'm going to show you the software. It's very easy to use. I'll show you kind of how we get here. But here's a comparison of the liquid assets. Strategy 1, just keep going the way you're going, status quo. Strategy 2, get the advance from CHEIFS and reposition it into a deferred and then immediate annuity, the Allianz ABC annuity. And as you can see, the liquid assets or significantly more during their retirement throughout. And at the same time, we produced $9.1 million of net after-tax income compared to 5.5 million with the status quo, just do nothing, keep going the way you're going. If we can look at the last slide, and then I'll jump in the software, but if we can look at the next, not last slide, but the next slide. And so there is a trade-off. Like everything in life, there's going to be a trade-off. And in return for having more liquidity and more income, what you're going to see is that strategy one does produce more net wealth to heirs, especially after age 90. So if you look at age 95, there's $4.8 million net to their children compared to only 3 million with the CHEIFS plan. And so that's something to consider. I guess the only point I would make is most clients would prefer to have $9 million of income during retirement versus 5 million and have a little bit less to their children. Not all, but the majority. And why? Well, real quick point. Why in the world would the heirs be getting less with the CHEIFS plan? Well, because with the CHEIFS plan, the client has sold a minority position in their home, and when their home is ultimately sold, that amount that goes back to CHEIFS is not in their estate. So go ahead, Craig.
I was going to say it's useful to remind the audience that at the time that Mr. and Mrs. Simpson, run out of spendable cash flow because they have no more liquid assets, but they have a lot of illiquid assets, which are mostly at that point their home. They have a couple of options. One of them is they're going to have to sell their house in order to fund the income that they need to live another 10, 15 plus years, which will take down the wealth to heirs pretty dramatically, not shown on this particular slide. Or alternatively, their children are going to have to fund the rest of their retirement. And the trade-off there is funding the rest of their retirement in return for a lot more net worth and wealth to the heirs when their parents pass away. So there are trade-offs, and then there are subsequent trade-offs.
Yeah, I mean, take me. My mom and my dad are in their late 80s. So they're older than these clients, but let's reverse the clock 20 or 30 years. If they came to me and said, hey, we'll do it, we're only worried about what you want us to do. And they said, me as I have two brothers, but the three of us being the children who would inherit the estate, I guess. And so if they showed me this, I would say, well, Mom, I mean, you need the 9 million. If you keep going the way you're going, you only got the 5.5. Me and Toby and Tracy, my other brother, we're going to have to make up that difference. We don't want you living under a bridge. So I don't care about the inheritance. Let's make sure you have the income you need. I think that's maybe not 100%, but it's over 90 is what the kids are going to say when they understand what you just said, Craig. So enough of this. Let me take you over to the software. I'm not going to spend a ton of time on complicated, hard to understand software. I'm just going to give you just an idea of how this looks. And let me know if you can you see the Wealthy and Wise screen?
I can.
Okay, great. So what you're seeing here is here's your status quo case where they do nothing. And then this is the case where we did the CHEIFS. So I'm just going to double click on this. This is where you have your different scenario cases. And what I'm going to do is, you see these tabs up here. This is where you enter in the client's assets and liabilities and when they were going to retire. Very simple. So here, I made this case very simple just so you can get the idea. So, under living expenses, we targeted 225,000 a year starting in the 11th year, as we saw. Expected cash flow, we have the 36,000 a year of Social Security coming in. We calculated that for them. As I said, they have $1.1 million in some type of qualified plan. I'm just clicking the tabs and telling you what they have in their assets. They have $1.2 million in mutual funds. They have a $1.5 million home. We assumed it would grow at 3%. They don't have any debt on the home. And so then you go over to the reports. And so if I look at the cash flow analysis, there it is. It's the same. If we need the 225,000, it's got to come from somewhere, right? So we started taking the money from the equity assets, and then the Social Security started kicking in here at age 70 when they decided to take it, and we had to start taking minimum distributions. Well, everything, we were out of money other than the Social Security. And so there's a million reports we can look at that we're not going to spend a ton of time on. I'll just do a summary of liquid assets. Here again, here's their retirement fund, here's their mutual funds, non-qualified. And as you can see, at age 84, they're out of liquidity. This is a bad plan. And so enough of that. If we go back, all we did is I made a copy of the status quo. I just copied it and made the only change we're going to make is we're going to do a CHEIFS transaction. So we're going to go back into here. And again, you got your tabs, you put in the information, put whatever you want. And so here, there's their home. And we're going to click this box. We're going to include CHEIFS. And then we go over here. And this shows that based on a $1.5 million home, the CHEIFS maximum advance was $326,437. Okay, and then this is showing the same thing Craig showed. It shows that, based on that advance, the amount due, is shown in this column. And you can see the APR over time. And because CHEIFS limits the recovery to 50% of the home value, as you get out over 30 years, you're talking about 5-6% APRs, which is very competitive. And so what we did is we took the 326,000 that now is new liquidity from the CHEIFS transaction, and we plugged it into a Allianz tax-deferred annuity, and this is what it produced in terms of income. So it cooked for, we had it cooked for, and you could design these however you want, but we cooked this for 16 years, and then we started pulling the income out from the ABC annuity. And so if I go into my reports, if I look at my cash flow analysis and see where the income's coming from, let's take a look at that. Well, now because we have the money coming from the annuity here in 7, we take pressure off of the retirement assets. And what ends up happening is, instead of being totally out of liquidity at age 84, the retirement fund still has almost $3 million there because the annuity is helping with the income need. And so again, if we can compare these things. This is just a comparison of these two plans down here. And now what you're going to see is you're going to see exactly what was on the PowerPoint. This was the numbers page. So 5.5 million, 9 million with the CHEIFS. If we go to the next page, you'll see that same graph we were looking at, liquid assets. I mean, and we'll go back to PowerPoint and see, I'll prove it. And then, we have this graph showing wealth to heirs. Remember I said that the wealth was more and the later is, okay. So one other thing I want to show before I move off of this, which is kind of cool that the software does, the Wealthy Wise software, I'll show you, is the first question I had was, okay, interesting, kind of a good idea to create liquidity from the home equity, but what about other options? And so inside here, if you do a CHEIFS transaction, you can also compare it to a HELOC. And let me kind of tell you how most HELOCs work. The way HELOCs work is they have a tenure where you pay interest only. It's called the draw period. And then typically there's another 10 years where you pay a amortizing payment based on some term, typically a 30-year amortizing payment. And then at the end of 20 years, you have a lump sum because the amortizing payment is longer than when the HELOC is required to be paid. Typically, there's a 1.5% origination fee. There's some appraisal costs. And let's say the average HELOC today is 8%. HELOC interest is only deductible if you use it to build a new kitchen, or it has to have something to do with the home. If you use it for anything else, income, credit card debt, it's not deductible. So you got to pay it all with after-tax dollars. And we'll come back to that in a minute. But I'm going to say the interest is not deductible because 90% of HELOCs are not used for a new kitchen. They're used for income, they're used for travel and so on. And then on the reverse mortgage, we plug in the reverse mortgage amount. So there's a really high upfront fee with reverse mortgages, and then there's an origination fee, typically $6,000. And then your rate's about 9%, but you got to add 0.5% for the annual insurance cost. So that's really reflective of what reverse mortgages are today. And all I wanted to show you all was, this is kind of cool. This shows, there's the numbers, but I'm going to show you graphically. So what you're going to see, and this is what most people don't know, is that reverse mortgages in the first 3 or 4 years are unbelievably expensive based on the assumptions. Your HELOC is 12.41. Well, no, it's not done. It was 8%. No, it's not 8% because you got to pay it with after-tax interest. After-tax salary earnings, because it's not deductible. And then you can see the CHEIFS plan. You see it starts kind of high, but look where it ends up here. Even in 20 years, we're down at 6-7%. And then all the way out here, you're down to 6%. So where CHEIFS makes a lot of sense is where you have clients probably over age 50. They're in their forever home. They might buy in a vacation home and so on, but all their friends are there. They're not going to leave, and they're relatively healthy. So one of them is going to be in the home in 20 or 30 years. Look at this number. And so what CHEIFS has done is they've developed a home equity product that the affluent will feel good about. The affluent, reverse mortgages, your cost of funds is 9.77%. It's going to eat up the entire value of the home. And I don't know about you, but I'm not going to borrow money at 9.77%. It's just not if I have to. Whereas when you look at the CHEIFS rate, 5% over 30 or 40 years, yeah, I'll look at getting that liquidity and repositioning it. That makes a lot of sense. So, okay. So what I'd like to do is have the screen go back to Craig, if we could. And I'm just going to show you one other case that's a little different case. If you can bring up the PowerPoint. Okay. So again, the case we just did, we had two 55, 54-year-old. They needed $225,000 of income. They had some assets in qualified, not qualified plans, and we ran the status quo. And then we said, okay, what's going to happen if we use the CHEIFS and reposition annuity, and things were better, at least from a liquidity income standpoint. This case is the second case. It's just a little different idea. With this case, what you have is you have a client that wants to do a Roth conversion, and they have $800,000 in a qualified plan that they want to convert to a Roth. Why? Because Jeff and Kim Rogers, both 55, they feel like the tax rates are going to be higher and higher over the next few decades. They're going to target the affluent. I'm not arguing for or against that. I'm telling you that that's how they felt. And so they're going to do this Roth conversion. And let's say the tax is 40%. So there's 800,000 coming over, a $320,000 amount of money they'll have to pay in tax. They have the funds to pay that. And then the question they had for me was, they said, with that Roth, let's say we pay the tax, and we have the 800,000 in the Roth, what income will that support starting at our retirement age 65? And the answer, as you can see in the numbers here, the answer is, if you can scroll down a little so you can see a little more of the slide. Oh, no, go back. I'm sorry, go back. Go back to the numbers. Okay. Yeah. The answer was, with that 800,000 in a Roth, go back to the number there. With the 800,000 in the Roth, it'll support 70,000 a year index for inflation. And that'll go out 40 years, and then the Roth is pretty much depleted. You can see there's $24,341 in the liquid assets. So that's kind of the status quo plan. And so they said, what do you think about that idea? And our response was, well, that's a good idea. We understand. That makes sense. If you think taxes are going to be a lot higher, maybe what we should consider doing is, instead of using the 320,000 from your savings, why don't we do a CHEIFS transaction and fund the 320,000 of tax? And then if we did that, then what would the liquidity look like in that scenario? Paying the same 70,000 that the status quo plan, or the, not status quo, but just the normal Roth conversion in red. Well, there it is. Income was exactly the same over the next 40 years, but now instead of $24,341 in liquid assets, because they allowed that 320,000 to continue to grow in their mutual funds, they have $2.7 million of additional liquidity. Well, that's a big deal. So the CHEIFS transaction afforded significantly more liquidity for this client throughout their lifetime. Let's go to the next slide, Craig, if we could. So again, we kept, as you can see in the bottom, we kept the income of that 70,000 a year. We kept the income the same, but look at the difference in liquidity because of the CHEIFS transaction, because we got the tax money from a source of liquidity they didn't know they had. Not rocket science, very straightforward concept. Let's go to the last slide, and then I'll show you the software quickly and run you through it. There is a trade-off, of course, because if we get some liquidity out of the home with the CHEIFS transaction, then when the home sells someday, part of the value of the home is going to go to CHEIFS to pay back the advance. And so as you can see, there's more wealth to heirs sort of in the first 20 years. The interesting thing about this was that with the CHEIFS transaction after age 80, the wealth to heirs actually flipped, and we actually are better in the later years because the growth of the mutual funds afforded even more wealth to heirs, even though they lose some of the value of the home and the estate. So if you could share the screen with me, I'll run you through the software. I just want to do it so you can see how easy it is, and then we'll be good to go. Can you see the wealth and wealth system? Okay. All right. So I'm just going to bring up this case, and so this is just the Roth conversion without the CHEIFS. This is this case, and I'm not going to spend a ton of time. I know this gets monotonous, but again, we kind of found the number of 70,000 a year that would deplete the $800,000 Roth. We're going to fund the tax with the equity account, and so if we look at the cash flow analysis. So they used the 320,000 from their equity assets, and then that allowed 800,000. If we look at the Roth report, this will be a little clearer. Let me see here. There we go. And so here's your Roth. And when it started producing that income, that's where it ended up. Remember that $24,000 figure? That's what it ended up with by using their savings to fund here's the Roth report I was looking for. Here we go. Okay, so they pay the $320,000 from savings. Here's their Roth at $800,000. We assumed it's growing 6.5. And then when we started taking the $70,000 a year out, we ended up depleting almost to $24,000. So pretty simple. Okay, Don, yeah, it's a Roth conversion. You pay the tax now. Got it. And then you converted that into what could that do for income? Okay, got it. So then the second case we did, we just copied this case right here. Everything's the same. Only difference is on this one, we came over here and we included a CHEIFS plan. So we got, again, here's your CHEIFS. We got 324,000 out, which funded the it funded the 320,000 of tax, and we actually had $4,800 left over to throw into their savings. And because we used the CHEIFS transaction, now the Roth was able to let me show you summary liquid assets. So what ended up happening was the Roth still depleted the same way, but because we were able to leave that 320,000 in mutual funds, this column 2 shows all the additional liquidity that was available to the clients throughout their lifetime because we used the CHEIFS transaction. And so, again, we can go back here and look at the summary graphs, and they will exactly match what we saw in the PowerPoint presentation. So here's your same income, but 24,000 left in the Roth, but we still, we said the same 24,000 in the Roth, but we have 2.7 million in mutual funds because we didn't have to use savings to pay the tax. And there it is graphically, and then this is the wealth to heirs that we saw. And I just want to show one other thing, and then I'm done, because I think it's interesting. So what you're going to see here is, again, with our Wealthy and Wise software, the scenario 1 is no changes to the client's current idea, their current, whether that's a full financial plan or whether I'm going to do a Roth conversion. And I want to see what that would look like if I just pay the tax. And then scenario 2 is where we use the CHEIFS funding to try to improve the client's income and liquidity in a way that he feels or she feels is an improvement. And so the point I'm trying to make is that the CHEIFS funding could be used for life insurance retirement plans, those LIRPs. It could be used for mutual funds, as we just saw with the Roth case. What about fully funding long-term care now? Well, scenario 1, you could project out with Wealthy and Wise and show in 20 years there's 100,000 a year of cost with long-term care. Scenario 2, we use CHEIFS, fully fund the long-term care, and then we don't have that huge expense that could happen in later years. The first case we did was where we were funding a deferred annuity. It was an all-assets annuity that converted to an income annuity, fair enough. But there's the funding Roth taxes. My point is this: the Wealthy and Wise software allows you to take the CHEIFS money, do a status quo, and then a change, and fund whatever you want. And then you can run the same annual cash flow reports on liquidity over time and net worth over time, and what's the estate look like, and what do the kids get. And so pretty straightforward stuff, but really valuable do it, don't do it comparative information. So go ahead and take the screen back, Craig, if you can. Great. And so that's what Wealthy and Wise does. It's I think very useful to see if things get better or things get worse. And sometimes that's depending on the client's, well, every time it's depending on the client's unique circumstances and risk profile and what they're trying to accomplish. So that's over to you, Craig.
Well, thank you. Missy, do I have control again?
Yes, you should have the PowerPoint there.
All right, let's just make sure I got it. Super. Well, Don, listen, that was great. And I know Dan and I speak from the same page here, that when we saw how CHEIFS stacks up versus status quo on a number of different retirement and financial planning strategies and scenarios, it really blew us away. And now that we've done this, several times it's got to be approaching almost 1,000 advisors at this point, both insurance and financial. Every time I look at it, I just say to myself, if nothing else, this is the kind of thing that clients and advisors ought to be aware of. And maybe more importantly, in a medium like Wealthy and Wise Advance that has been used for over 40 years by 30,000 professional advanced sales and insurance advisors and financial advisors, and sponsored by well over 100 carriers. It's the right way to be able to show ultimately your clients what are the different trade-offs when it comes to funding these really important investment and insurance products as you go through retirement with cash, with AUM liquidation, or potentially with home equity. So, Missy, let me wrap things up here. Home equity instruments, products like CHEIFS, can certainly play a meaningful role in helping advisors serve their clients better. I think that goes without saying. Utilizing what is often their largest asset as a funding source to purchase these really important retirement-oriented products that Don has been talking about. CHEIFS have been designed specifically for the mass affluent and higher net worth demographic, delivering a compelling value proposition for advisors and their clients as an alternative funding source versus cash or AUM liquidation. And as Don pointed out, I mean, he said it really, really well. The applications of CHEIFS are nearly unlimited. I mean, nearly unlimited. I talked before about the fact that in 2024, there was $450 billion of new life insurance, annuity, and long-term care insurance premiums originated. By definition, that's $450 billion that was funded with cash on hand and or AUM liquidation. And for the ultra high net worth, maybe traditional premium finance was an option, but that's it. And that does not include the hundreds and hundreds of billions of in-force funding premiums on existing policies that are paid each year that oftentimes are paid through the liquidation of AUM. So, you know, one of the things that we like to say about CHEIFS is that it is AUM protection for the advisors. Not that that's critical, but, you know, it goes without saying that if advisors have more options and can be, you know, more thoughtful, perhaps aggressive in investment management, that can be really helpful for your clients long-term, especially when it comes down to alleviating what is oftentimes their greatest concern, which is running out of money. If you're interested in speaking with me or with Dan about CHEIFS, our contact information is listed here. You can go to our site, chiefs.com, spelled the right way, not the way those football players in Kansas City spell it. You can also go to cornerstonefinancing.com and you can learn more about the product and where we currently do business, which is in 20 states. And if you're interested in learning more about InsMark, I'm going to do the InsMark commercial right now, and their Wealthy and Wise platforms and their other software solutions for insurance and financial advisors. Don and Dave's contact information is listed here, and you can go to insmark.com. So, Missy, I'm done. I want to thank everybody for attending. And of course, we're very happy to take any questions that they may have.
Wonderful. And before we get to that, I do want to, I know that you have this information up there, but we also wanted to do the polling questions to see if people wanted to opt in. We can just get you the information. We'll get the information over to Dawn for this and Dan. So this way we can just do it. If you opt in, we'll get your contact information. This is for the CHEIFS Home Equity Solution. And then we're also going to do a question for the software too. So let me give everybody, I see about half of you guys have found the polling question. Sometimes you may need to minimize a window to see the polling question come up. And also, you know, there is obviously in the slide deck, the contact information if you want to reach out directly. So I'm going to go ahead and close this and launch the question about the, here we go, the Wealthy and Wise solution. So if you want to just opt into this, and we know that, you know, we did email this out for some of the current clients, so you may already work with them. So we do have that option there too. So either yes, you would like them to contact you, no thank you. So we appreciate everybody jumping on and answering these before we get into Q&A. And we do have a number of questions. So, and I tried to like timestamp when they came in because some of them were specific to like case 1, case 2 in the second part of the program too. So we're gonna try to do our best to get through those. So thank you everyone who opted in on here. Let me close this out. And then, yeah, well, that's great, Craig, just leaving up Dawn's information, or you can switch it over your information. But we will go ahead and go through our questions. This is perfect. Okay, so this is from your part of the presentation, Craig. This was from Roger. He's asking, does the product prevent a client from having a reverse mortgage? And how is it different from a key agreement? So a couple questions there.
I'll take those in reverse, no pun intended. So the key agreement, and candidly, every other HEI product that's in the marketplace today, tends to be a product that is offered to what I would call subprime type of consumers, credit impaired consumers, those who are in distressed debt situations. The amount that can be taken out through some of those HEI products tend to be potentially more than what a CHEIFS can provide. But they also come at a much higher cost, typically in the near 20% per annum potential range. The reason that we went down the path we did, and sometimes it's just, a blinding flash of the obvious, is that the idea of selling, 20% of your investment portfolio to fund the kind of products that Don talked about before should really be no different than potentially selling 20% of your house to also fund the kind of products that Don was talking about before. That shouldn't ever have to be an either or decision in the context of you can only do one, selling 20% of your investment portfolio and not being able to sell 20% of your house. And for the mass affluent and higher net worth, that's the conversation that they have with their advisors nearly every single day. How am I going to find the funds to pay for these important solutions and strategies and products? So we figured out very quickly that the HEI construct is interesting, not the application that's out there with other HEI companies, but it's interesting in that it comes down to asset reallocation. And if we can create what we call a super prime type of CHEIFS product that is very compelling from a cost perspective, it's not needs-based, but rather it's wants-based. I want to do this versus liquidating 20% of my investment portfolio. There might be a market. And that's what Dan and I have figured out after spending, more than a year on the road with 20 plus carriers, literally thousands and thousands of insurance and financial advisors, just asking them, about this idea. And the feedback that we've gotten back has been, this is transformational and really, really exciting. So that's the big difference between our product and the key and other HEI products. Missy, can you remind me what the first question was?
Sure. It was, does the product prevent a client from having a reverse mortgage?
So if a CHEIF is done in the first lien position, so there's no other mortgage, someone's certainly welcome to take out a mortgage on the back of us. My understanding, however, is if someone wants to take out a reverse mortgage, those reverse mortgage proceeds must be used to pay off any first lien mortgage. And if the CHEIF was in the first lien position, the reverse mortgage proceeds would be used to pay off our product, which is fine. There's no prepayment penalties. You can pay off a CHEIF whenever you want to. So it wouldn't prevent someone from taking out a reverse mortgage, but the reverse mortgage lender would require those proceeds be used to pay off any existing debt, including a CHEIFS product.
Got it. Scott is asking, what index is used to garner your return?
So there is no index, funny enough. What you saw on one of the earlier slides is exactly what our return ultimately looks like. So we are going to, in the first 5, 6, 7 years, unless home prices were to fall fairly dramatically, we're going to earn a fixed rate of about 12.99%. But as home prices and the tenor of the CHEIFS contract continues to lengthen, our return will come down and it will inevitably start to approach long-term home price appreciation rates. So out 15, 20, 25 years, our returns, as Don mentioned before, start to gravitate towards 5 to 6 to 7% per year, fixed, not linked to any index.
Okay. And I'm sorry I didn't mention this to our audience. If you were on since the beginning and you have somewhere you need to be at this point and you wanted to earn those CE credits, you did fulfill the minimum time required for that. So if you do have to hop off, you are welcome to do that. Obviously, everybody always learns something in the Q&A portion. So if you are able to, stay and listen. And also, we always have a replay of all of our broadcasts on our website, financialexpertsnetwork.com. I think we have over 500 past webinars there. So if you missed this or want to go back and look at any of ours, you can go there if you do want to listen back or if you happen to miss something. Okay, so our next question is coming from Scott. It would seem that CHEIFS payoff is tied to the value of the home, if not sold, to determine the payout amount. What index are you basing the value on?
It's ultimately based on the value of the home.
Okay. Okay. Roger's asking, can CHEIF be used to purchase a home?
Of course it can. And in fact, we've done transactions where someone was living in their mortgage-free home, wanted to purchase a second home, smaller home, but a second home, used a CHEIF on their first home to make a sizable down payment on the second home that they purchased. Ironically, they actually thought about doing a CHEIF on the second house so that there was literally no payment made on that second house, but ultimately didn't go down that path. So think about what they did. They went from owning 100% exposure to one home to having less than 100% exposure on one home and full exposure on the second home.
Okay. Carrie's asking, how would this compare to doing an is it S block, SBLOC from the InsMark example, from the 1.2 million in non-qualified mutual fund portfolio and using dividends to pay back the S block instead of CHEIFS?
Don, I definitely can't answer that. I'm not a financial advisor.
Yes. So here's what I would say. I don't know because I'm also, we're a software company that listens to financial advisors and gets input. What I would say is you can model anything to answer the question you just asked. And so I don't know what an S block is, but whatever kind of financial instrument you just described, I'm quite sure that you could model that in Wealthy and Wise and then compare results. And you can compare up to 3 different results. So you could do the first 2 that I did and then add the third, and then graphs would show, instead of 2 scenarios, it would show 3. And you would know well, what happens with liquidity, what happens with income, what happens with wealth to heirs, and so on. So I have advisors that are very skilled at using Wealthy and Wise and can pretty much model anything. And so if you want to follow up with me and connect with those advisors who are experts with Wealthy and Wise, I'm sure they could build the case for you or help you with how to do it.
Let me jump in here. I'm sorry, it's Tom. I'm just to clarify, the SBLOC, as Karen was kind enough to point out, that it's a securities-based line of credit. So in other words, basically, I'll call it margin. And so it's another line of credit tied to the brokerage account, as I'm guessing. So there you're going to have a cost of funds, et cetera. And I'm guessing, as Don's pointing out, you could model that side by side with relative ease. So good question. Thanks, Karen, and Carrie. Thank you. And Missy, I'll hand it off to you again.
Okay, great, thanks. So Carrie was also asking, the future value of the total CHEIFS payment will never exceed 50% of the home value. Is that correct?
That's the max. Of course, a homeowner can decide that they don't want to sell, more than 25% of the future value of the property. It's completely up to them. It's their decision, but Cornerstone will never have more than a 50% interest in one's home.
Great. Jim posed this question. Can this be done if they already have an existing mortgage balance, or does it only work if the home is owned free and clear?
So it can be done on homes that have an existing mortgage. And in fact, to date, roughly 70% of the transactions that we've done have been done where there's a small mortgage on the property. The other 30% have been done where there's no mortgage at all. So the answer is yes, and it's actually not uncommon.
Okay. So now we're getting into the section of the program where Dawn was presenting some of the software. So some of these questions are going to be more directed at you, Dawn. Roger's asking, can the software show increasing SSI payments or pension payments?
Absolutely. For inflation, or you can model that any way you want. Either for automatically with an annual inflation rate, or you can change the inflation rate every year, or you can copy and paste an array. Yes, no problem. Okay. Yes.
Perfect. Let's see. Jim's asking, what happens when the client sells the home?
So when the client sells the home, an appraisal is done to determine that the sales price and the appraisal are, in sync, so that there's no, underhanded selling. And at that point in time, we are at Cornerstone entitled to whatever contractual percentage of the value of the property. So if the property sells for $2 million and we're entitled to 25% of it, we get $500,000 and the homeowner retains $1.5 million.
Okay, great. Jim's asking, does this pass each of the securities and insurance compliance, which often doesn't want the client to pull equity from a house to purchase an investment or insurance product?
So Don, I'm going to answer one part of that question. You might want to answer perhaps the second part. So what's important about that question, and it ties directly to a FINRA regulation called 04-89, is that using home equity through a lens of debt, like a mortgage or a HELOC or something where there is a payment obligation, is something that FINRA wants to make sure there are additional disclosures required to be made by the FINRA regulated advisor to their client in order to make sure they understand what they're getting into. CHEIFS are not debt. CHEIFS are actually a forward sale of someone's home, and they do not fit in very well with section 04-89 of that particular FINRA rule. It's one of the reasons that we saw the appeal of these home equity instruments, because they're not traditional debt type of instruments. They're the concept of selling X% of one's home, no different than selling Y% of someone's investment portfolio. They're considered current assets that can be monetized, and they're monetized through a fractional sale, as we described today. So we actually spent a lot of time with outside counsel on this issue, and that was the feedback from outside counsel, that CHEIFS are very different than the kind of debt products that FINRA was focused on when it crafted 04-89.
Yeah, all I would say to add to that is taking on debt to invest in an annuity or whatever clearly has some issues, as Craig just explained. However, this is a very different scenario, because with Wealthy and Wise, you're specifically showing the impact of the status quo versus the change, and then how it impacts things as it pertains to liquidity and net worth and estate value. And so to me, what Wealthy and Wise does, in addition to providing good information, but it also helps satisfy the requirement of acting in the best interest of the client. And so, I think it's a little different situation when you're showing Wealthy and Wise in a comparative analysis based on the assumptions the client feels are reasonable. So I would argue that not doing something like a wealthy and wise for any decision, funded however you want, is problematic from a compliance standpoint. I think that advisors should always be showing, here's what happens if you don't do it, here's what happens if you do. So those would be the comments I would have.
Okay. Roger's asking, if I'm selling a portion of my appreciated home, will I need to pay capital gains? He hasn't heard about any of the tax treatment of CHEIFS proceeds.
So let's talk about that. It's a great question. So when you do a CHEIFS transaction, you're selling a portion of your home. Those proceeds that you get will eventually form part of the capital gain basis when you do sell your house. So as an example, you have $1 million house, you take out a CHEIF for $100,000, you sell that $1 million house for $2 million, and we're entitled to 20% of the home, so $400,000. Your client has netted 1.6 million post CHEIFS transaction. That 1.6 plus the $100,000 that they received up front now represents their capital gain basis. Obviously, their cost basis hasn't changed. It is whatever it is. What's interesting about CHEIFS is that it could be a very effective way to reduce some of the tax burden, especially on highly appreciated homes.
Okay, great.
But the key point there, Craig, the key point you're making, though, is that the time the CHEIFS advance is made, the home might be sold 20, 30 years later, but at the time the CHEIFS advance is made, those CHEIFS funds are not capital gain taxable, is the point you're making.
They are not taxable on day one. The only tax possibility occurs when the house is sold.
Great. Yeah, it's just out of the basis, like you said. Andrea is asking, what happens if non-paying people move into the home, i.e. relatives? What if the home becomes a rental? Is repayment triggered immediately?
Yeah, so I mentioned earlier, CHEIFS can be done on your primary owner-occupied property, your second one, your third, your fifth, it doesn't matter, as long as they're not investment properties, as long as they're not rental properties. So if someone took out a CHEIF on a primary residence that they occupied and they decided to turn that into an investment in property, that would trigger a reason for the CHEIF to become due and payable. Missy, I'm not sure if that answered both parts of the question or just the one part.
Sorry, I was scrolling through to some other questions. It just asked if non-paying people move into the home, relatives. Mm-hmm.
Yeah, so kind of like a typical mortgage. When someone takes out a CHEIF, we list who the quote unquote borrowers are, for lack of a better phrase. And when those individuals either A, pass away, or B, permanently move out of the house, or C, voluntarily decide to repay it, as I mentioned before, there are no prepayment penalties. That's when CHEIFS are due and payable. If someone steps into the home and is now living there, but the original signatories of the CHEIF contract are no longer there, at the time that those individuals are no longer there is when the transaction becomes due and payable, and they can pay off the CHEIF however they choose to. They don't have to sell it. As you all know, you can retain it.
Okay, great. Jeff is asking for you to comment. Please compare the CHEIFS cost/benefit to a reverse mortgage for Bill and Mary Simpson.
Yeah, so Don, I'll take this one if you don't mind.
Yeah.
So
sure.
Bill and Mary have a $1.5 million house, and they took out, I think it was $326,000 with a CHEIF. Reverse mortgages, typically the mortgage insurance premium associated with a reverse mortgage is on the value of the property. So $1.5 million, I think it's 2 points, capped at about $25,000. So that's a real cost associated with taking out a reverse mortgage in the scenario that I just described. So that's just the insurance premium. then there are origination fees on top of that. And I think in the Wealthy and Wise software, those origination fees were roughly $6,000, which is typical for a transaction that big. So let me frame this. $24,000 of insurance premiums upfront, $6,000 of origination fees upfront. That sounds like $30,000 so far. And we haven't even gotten into the appraisal, title, and things like that. Let's just call it another couple $1,000s. So $32,000 to get $326,000 on day one. That's a cost of 10% on the balance of the loan in order to take out a reverse mortgage. And I think what Don showed so elegantly was that upfront cost, when amortized over the life of a reverse mortgage, is really high in the first 4, 5, 6, 7 years.
Yeah, hey, Craig, can you share the screen with me and I'll just show exactly what you just said, and then people can see it graphically.
I'll go back. Yeah,
Okay, so I'm gonna, tell me if you can see the screen. This is the Simpsons plan. Can you see the screen?
Yep.
Okay, so we're gonna include the CHEIFS plan. I'm on the, this tab in the middle, right? And I'm gonna go in here and I'm gonna look at the HELOC and I'm gonna say, okay, these are very typical HELOCs, 10 years interest only, 20-year payoff, 30-year amortization, setting the payment the second 10 years, 1.5 origination, 2,000 fees. Craig, interrupt at any point, 8%. So that's what we're going to look at for the HELOC. Is that okay? Those assumptions okay, Craig?
Yeah, everything's reasonable.
All right. I'm assuming the interest is not deductible on the HELOC. We can come back in and make it deductible if they're going to build a new kitchen or something. On the reverse mortgage, I've got a $24,195 upfront cost, origination fee of $6,000. Oh, what do you want for other closing costs? A couple thousand?
Yeah, 2,000. That seems right.
All right, and then what do you want for the interest rate, including the annual insurance premium? What rate? I already looked in.
Make it 7.5%. Let's assume it's the FHA insured product, so 7.5%.
Okay, so now we're going to go over here and look at it. And what you'll see is here's the CHEIFS APR in column 5. There's a reverse mortgage in column 6. There's your HELOC in column 7. And if you would look graphically, so what you're going to see is the purple line is the reverse mortgage. Starts pretty high with those costs. The brown line is the CHEIFS. And you can see out about 20 years, 15 to 20 years, the CHEIFS is significantly and continues to go down. And then the HELOC really it doesn't really even compete because you got to pay all the money back. And the whole point of CHEIFS or reverse mortgages is to kind of kick the can down the road. And then ultimately, when people are going, at their older ages, that's when the money is paid back. But when they're leaving the home, either dying or nursing home and so on. So in any event, is that helpful, that graph?
I think it would be for them. I'll let them comment.
Greg, is that showing what you think it should show?
Yeah, I think broadly speaking it is. And I think the takeaway is any kind of financing, if it's short-term, is expensive. Reverse mortgages tend to be super expensive if it's short-term financing. Like anything, yeah. The longer you have something outstanding, the less expensive it tends to be. And I think we demonstrated on multiple occasions today that, CHEIFS are longer term, just a very attractive cost of funding relative to some of the other products that advisors have asked us to show them in a compare and contrast environment, which, we've shown this, many, many times.
Yeah, and please take control back at any time.
And we still have about a dozen questions left. So just to give you guys a heads up, if you guys are still good with going through some of these questions.
Absolutely.
All right, I sent the screen back to you, Craig, I believe. Let me just go ahead with the next question from Mark. He's asking, how does the sale of a portion of the home affect qualification for Medicaid for long-term care? Do you know how that would affect that?
I actually can tell you, I don't think I do know the answer to that question. It's a great question.
Okay. Okay. Yeah, we'll see if we can get any more information on that. Let's see. Another question: does Cornerstone pay a portion of taxes and insurance during the period of fractional ownership?
I love that question. It's one of my favorites. So no, we not only do not pay taxes or portion of the upkeep of the home, but we also don't get a chance to spend 25 or 50% of the time at the house. So the trade-off really is as follows. The homeowner gets 100% of the non-economic benefits of home ownership, but they still maintain the home, they still pay their taxes, and they sell away 20 or 30% of the economic benefits. We, of course, don't have the ability to spend any time there at all. It remains the homeowner's home. They can do whatever they want to the home. They can sell it whenever they want. And of course, they can pay the CHEIFS off whenever they choose to.
Great. What's the top percentage of ownership that CHEIFS grows to over time?
50%.
Mm-hmm. Yeah. All right. Richard's asking, do you do business in Florida?
We do.
Okay. Michael's asking, how can I get a loan on my second home? Fair market value of $750,000 to $800,000.
So how much could you do on a $750,000 to $800,000 home?
I believe that's the question.
Roughly $150,000. We would.
Oh, sorry, get a follow-up question. Sorry, maybe this will help. It says, what's the process and fees involved? So, sorry.
Okay. Yeah, so on transactions that are referred to us by advisors, we charge our clients 1.5% of the investment that we make. So if it's a $150,000 investment that we make, we charge them 1.5%. And they also pay the title, insurance, they pay the appraisal, which will ultimately run to about $1,500, maybe almost as high as $2,000. So it's extremely cost efficient from that perspective, much more so than some of the costs that you just saw that Don shared as it relates to, let's say, reverse mortgages.
Okay. Dennis
Hey,
is
Craig,
asking,
can I jump in? Listen, I'm sorry, quick question. Someone's emailed me separate from all this and asked if you're doing business in Arkansas, Craig.
You know, I think Arkansas is a state that we're not doing business in, but if Arkansas is a state that we ought to be doing business in, we have the ability to dictate where we do business. So we'd love to have a conversation with that particular advisor.
And Craig, with that in mind, do you, and Cody, and someone's already asking about Colorado and Arizona, I guess the question largely would be, what are your plans for expansion? Do you intend to try to do all 50 states, or what's your goal, say, in the next 6 to 12 months?
Yeah, so we're in 20 states today. You can see that on cornerstonefinancing.com or CHEIFS.com. And those 20 states cover roughly 50% of the population of the country. So pretty broad coverage right now. The intent is to be in all states at some point. We've got, I believe, 13 states teed up for us to be in over the next 3 to 6 months. And once we're in those 13 additional states, that'll get us up to nearly 75% population coverage. The one state that is going to remain a challenge for us, for those who do business in Texas, is Texas.
Oh, and I wanted to make one comment too. I have to go in 5 minutes. So if, and I couldn't bear my background on this platform. I apologize. I'm not at InsMark today, so I'm sorry for the bed in the back. Anyways, if you have any questions for InsMark, maybe ask those, or maybe David Grant can stay on, but I do need to go in 5 minutes.
okay, great.
Don, thank you.
Yeah, I can stay on, Don.
Okay, fine. But I'm good for 5. I just wanted to mention that.
Great. Yeah, let's see what we can get through. Dennis is asking, what are the costs and fees? And I think you kind of discussed that. And is counseling required like a HECM?
Yeah, so no counseling is required. Remember, our distribution model is purely through advisors. And that means we're oftentimes, if not almost all the time, dealing with homeowners who tend to be more mass affluent, higher net worth, have a professional who can help them understand the differences between doing nothing, status quo, versus looking at a CHEIF, and also comparing CHEIFs to other funding products that might be out in the marketplace. That's been a really important part of the development of our business model, is making sure that advisors, A, understand the CHEIF product and program, how it can be applied, how it compares to other funding products that are in the marketplace. Those are the things that help advisors inform their clients around all of the options that might be available to them. And from Don and our perspective, when you show options, you're satisfying a lot of the best interest requirements that these advisors are required to comply with.
Great. Jeff is asking, what happens to the home's capital gain at sale? I think you kind of addressed that already, but if you want to comment on that again. And after an owner's death, how does step-up basis work?
So I would, I'll start with the first one. I don't think I'm well positioned to handle the second one. On the first one, the sum of the money that you get from a CHEIFS transaction plus the net proceeds you get after you sell your home, that represents the amount of potential capital gains that you have on your property. So an example, you have $1 million property, you get $100,000 on a CHEIFS transaction, you sell your property for $2 million. We share 400,000 of that, so you net 1.6. That 1.6 plus the $100,000 that you got when you took out the CHEIFS transaction 20 years ago, that's the $1.7 million that you need to be mindful of for capital gains purposes. What your capital gain is has nothing to do with CHEIF. It has everything to do with your cost basis.
Yeah, and let me comment on the second part of the question, which is upon someone's death, their assets take a step up in basis. So if you bought a home for $100,000 and 20 years later you die and the home's worth $2 million, the new basis at death is $2 million. So there's no capital gains tax. It's included in your estate, but there's no capital gains tax. And while I'm not 100% sure of this, because the CHEIFS transaction is an advance on a forward sale, I would guess that in the event of a death, there would be no capital gains tax, not on the gain, not on the CHEIFS advance.
I think that's right, Don.
Yeah, I think that's right.
All right. And I just wanted to thank you, Don, for being here. If you do have to jump, I just wanted to make sure I got that, Tom, and I appreciate your time today, and we'll be in touch. But whenever you have to jump, just want to say thank you for being here.
Okay.
Appreciate it.
I'll sign off. David Grant with InsMark is here, and he can answer any other InsMark related questions. So thanks so much.
Thanks, Don.
Thank you, Don.
Jeff is our next question. What happens to a home's capital? Oh, I'm sorry, we just did that one. Michael's asking, hi, does advisor get any commission from CHEIFS for a client referral?
So the answer is no.
Mm-hmm.
The way we structured this is that we're not in the pockets of the insurance or financial advisor for how the proceeds are used, and any commission or revenue that's generated off of that, that's completely up to the advisor. No different than the advisor selling 20% of one's investment portfolio and using those proceeds to purchase something else. We have nothing to do with that part of the transaction. Likewise, we don't pay out any referral fees. We don't pay out any commission on what we generate. That allows us to keep the origination fee on CHEIFS as low as it is. Mm-hmm. That's what makes the value proposition so darn compelling. It's what makes CHEIFS a super prime type of product.
Okay. William's asking, once the CHEIFS transaction is done, how does the CHEIFS ownership interest, how is the CHEIFS ownership interest recorded in real estate records?
So there is no change in ownership interest in real estate records. It is your client's home. Before they take out a CHEIF, it's your client's home. after they take out a chief, and it's your client's home after they pay off the chief. There's no record of us as being an owner of the property. The only thing that's recorded is a mortgage or a deed of trust that evidences our interest in the property when the property is ultimately sold, and we're entitled to whatever percent of the value of the property we're entitled to.
Okay. Great. Jim's asking, what if this is done on a married couple and one needs to relocate to a nursing home for long-term care, but the other spouse stays home and it's a jointly owned home?
That's fine. It's paid off at the death or permanent move out of the second individual,
Okay.
or the last remaining borrower, so to say.
Michelle is asking, will you run scenarios for them if they're considering using this for a client? And do you have an example with a proposal that discloses the fees?
Yes. Go right to our website and you can actually request a conversation with one of our sales support folks who support advisors like, the person who asked that question.
Okay, great. Charles is asking, I'm from Texas. What are the challenges in Texas?
Texas is a wonderful state. My favorite football team is the Cowboys. Don't bash me for that. But with that being said, Texas has some fairly archaic homestead laws. And we've discussed, doing chiefs in Texas as recently as a couple of weeks ago with outside counsel. And it's not out of the question. It may require a constitutional change to have a product like chiefs and any other kind of equity sharing, appreciation sharing product allowed in the state of Texas. So we're going to give it a shot because Texas is a great state with a lot of homeowners who have a lot of equity, but it's got some really interesting homestead laws.
Okay, great. And I did bounce around a little bit in the question. So if you're still on and I did happen to miss something that you did put in here, please just put a note in there or the question again, and I'll be sure to answer that. But I do have one more question from Joe. He was asking, can an insurance agent like him, who isn't well-versed yet with this concept, but have a highly qualified client, be assisted?
Yes, please. You have here, I'll go to it right now. Whoops. Here is mine, Dan's contact information. Go to our site. There's a way right on our site to reach out to us, and one of our sales support people will, contact you immediately. I mean, this is literally what we do. We have we've had hundreds and hundreds of advisors reach out to us, like through a seminar like this or directly from our site. So please reach out. We'd love to help.
Great, yeah. And you do have the slides there. They are available for download over in the GoToWebinar interface. So you can download those and have this contact information if you don't get a chance to write it down. And again, you can watch replay or access these materials on our website too. Jim is asking, what is a typical closing time frame?
2 to 4 weeks.
Okay. All right. And I believe that is the end of the questions that I have here now. I know you talked about some of the states. Jeff was asking, do you do South Carolina?
I think so.
Okay. And you said you have a list of those on your site, right? Yeah.
We do.
Yep. So again, you can find that there. But I don't see any other questions coming in, but you did stay on for all of these questions. So kudos for you. Thank you for being here.
Missy, can I add one thing?
Of course, David.
I want to make sure everybody knew that I wasn't totally mute and I was actually listening today. To go back to kind of the question Craig just answered regarding their support there on the initial Chiefs transaction for someone who needs a little help. When it comes to the wealthy and wise part of the transaction, we have 3 or 4 specialists that actually will help you put the case together, help you do everything from soup to nuts for you if you wanted them to. And you obviously share a little bit in that case, just like most, transactions like that. Obviously you can call our office. You have the numbers for all of us as well. And at that time we can talk about the software and the cost and so forth. We do have something going on special here for the next 7 days after this webinar. Let's just say it's about a 50% discount. So if you're interested in moving forward with Chiefs and in using the Wealthy and Wise platform to do the great things that Don showed you, please give us a call and reach out, and we'll take care of you.
Great. Yeah. Just be sure to mention that you were on this webinar whenever you talk to David. And if you did opt into these the surveys, we're going to get that information over to him by tomorrow. So you're not going to miss out on that discount time period. So appreciate everybody who did opt into that. We're going to get that information over, and you have the contact information. Craig and David, again, thank you guys for being here. And we always appreciate, all of our experts coming in, spending this time educating our audience. So thank you for that.